दोस्तों, आज हम जिस विषय पे बात करेंगे वह है कर टैक्सेस। We have already said that the main way of the government earns money is through taxation. But how does it goes about deciding what to tax and how much? Again, this is the subject of much debate, and principles can vary around the world depending on policies. Traditionally, more right-wing politicians argues for much lower taxes, while the more left of the center prefers a system which is more redistributive to spread wealth in the society around. The Scottish economist Adam Smith proposed four canons or principles of taxation which most economists still hold to be true today. First of this, all the cost of collection must be low relative to the amount being collected. Second, the timing and the amount to be paid should be certain to the payer. Third, the means of and timings of payment should be convenient to the payer. And finally, taxes should be levied depending on the ability to pay. Norway's economists also add another three principles. Any tax should involve the least loss of efficiency, that is, it should not change people's behavior. It should also be compatible with foreign tax systems, and it should automatically adjust to changes in inflation. The main types of taxation include income tax, which applies to a person's earning, corporate taxation, which applies to a company's profits, VAT or sales tax, which is levied on purchases, wealth tax, which can be exercised on a person's assets holding. Property is an example, and excise duty, which is an additional sales tax on items like cigarettes, alcohol, or fuel. In addition, economists distinguish between direct and indirect taxes. Income tax falls into the first category because it applied to your own earnings and paid directly to the government. VAT, on the other hand, is an indirect tax because it is charged on goods and services that you pay to the vendor, who then pays it to the government. Economists also like to distinguish between progressive, regressive, and proportional taxes. A progressive tax is one of which the proportional paid increases as the amount being taxed goes up. This is a common of most income tax systems in developed countries, where people on higher incomes pays higher rates of taxes. Typically, income tax involves a tax-free threshold under which the individual pays nothing. Anything above that then might be taxed at a basic rate, say 20%. Earnings above a particular level, after that, then might be taxed at a even higher rate, say 30 or 40%. This would means those on higher incomes pays proportionally more and is in keeping with a view to the tax systems being used to redistribute wealth. A proportional tax is one where the percentage paid in taxation stays the same as income increases. This is often referred to as a flat tax, as everyone, whatever their income, would pay the same rate of tax. A number of Eastern Europe economies like Lithuania, Estonia have a flat tax regime. Regressive tax, on the other hand, are where the percentage paid in tax decreases as income increases. Common examples would be VAT or excise duties, which are applied to the goods being taxed, while the rate as a percentage of price of a good or services may be the same for every one. It will take up a bigger slice of poorer people's income. Economists also want tax systems to take account of inflation. So, ideally, they would want these holds to rise in line with price rises in the economy. Governments also need to think about what is right level of taxation is, because in some cases setting rates too high might actually be self defending. For example, many people still travel to continental Europe from Britain for so called Bruzy courses to stock up on alcohol to benefit from lower taxes in France. The UK government has to balance any decision to raise duty on alcohol at home against how many more people might start buying their drinks abroad. Similarly, rising income or corporation tax too far might lead to peoples or business reallocating abroad, or it could encourage peoples to find a way to escape tax altogether through loopholes and avoidance measures. Taxes that are too high may also discourage people from working more and instead opt to do nothing. The Laffer curve, named after the US economist Arthur Laffer, tries to show what the relationship between government's revenue and tax rates might look like. Laffer notes that if there were no taxes at all, that is, the tax rates was zero, then the government would get no tax revenue. But if the tax rates was 100%, that is, the government took everything you earn, then there would also be no tax revenue, as there would be no reason for anyone to work. Everything they earned would go to tax. Therefore, he said that if you plotted a graph of tax revenue against tax rates, you would get a curve which showed that both 0 and 100 tax rates produced no revenue. As tax rates rose above zero, so too did government revenue, but at same point tax revenues would decline as the rate nearest to 100%.